Hi, I'm James Nelson, Principal and Head of Tri-State Investment Sales for Avison Young, and I'm here to give you the Nelson Reports video exclusive for September 2018. Hope you all had a great summer. So today we're going to be talking about opportunity funds, okay? Now, if you're like me, a couple months ago, no one had even heard of these, and now it seems to be what everyone's talking about. And this was part of the 2017 Tax Cut and Jobs Act, but not a lot of people were paying attention to this provision because it mostly applied or was maybe even said intended for operating businesses. Think of farmers out in the Midwest buying tractor trailers. Now, what's interesting though is this has very powerful implications for real estate. So look, before we go on, I'm going to give a very big caveat and disclaimer, which is there is a lot that is still up in the air about this, and what I'm about to tell you, you need to check carefully with your accountant and with counsel. But I will say that I'm very grateful to my friends at Herrick as well as Greenberg Traurig, and have also spoken to some of my accounting friends at Mazars and Eisner Amper about this, and I've seen a lot of briefs, but there's still a lot that needs to be spelled out. So yes, this was introduced, and then the government, the Treasury, gave states the right to pick census tracts. They could pick up to 25% of their census tracts, which happened in New York in April. So if that's why suddenly we've started to hear a lot about this, because now these areas have been designated. My understanding is these are permanent. This has been done. And I think the map will surprise you in that, you know, some of the areas, and there's 35 of them in northern Manhattan, but south of 96th Street, we've got over near Hudson Yards, we have some on the Lower East Side. So what does this all mean, and why is this going to have such a massive impact? Well, first of all, the intention of the program was to encourage investments in low-income, middle-income areas, and this will certainly do so. So what this is allowing is for anyone to defer a capital gain initially, okay? Now, this is where we start to diverge from a 1031 tax-free exchange. 1031 tax-free exchange is, as my audience knows, is for like-kind exchanges for real estate investors who sold and have deferred into real estate, okay? Opportunity zones opens up this whole new world because any capital gain can be applied towards real estate. Think of someone who just sold their Facebook shares. Think about a family office. Think about hedge funds. We are going to be welcoming in a whole new audience of investors for real estate. So that alone, to me, is incredibly exciting, okay? But what gets me really excited is the prospect of being able to ultimately receive profits tax-free, okay? When can you ever get a return tax-free? In real estate, with the exception of the primary residence $500,000 shelter for couples, this is the only one that I've heard of. All right, so how does this work? Okay, so we're assuming that you are making this investment in a designated opportunity zone. What you're going to do is put your money into an opportunity fund, okay, that's going to be designated for this area. So let's say that we have a $10 million capital gain, okay? Now, this has to be invested, after you make this sale, it has to be invested within 180 days, okay? That's the way it works. Now, I know I'm going to start getting questions, well, James, you know, what if I put the money in and then I need to get some money to do the work? How does that time frame work? To be determined, okay? That's one of the questions that my legal and accounting friends are looking for clarification. But the way this works is that when you buy a property, and my understanding right now is this is really going to work best for existing properties, right, as opposed to land, because I'm not going to get too technical, but land does not qualify for what a first use is, okay? It needs to be a property where you can go in and make a substantial rehab. So let's think about that building that you buy for $5 million and you make a $5 million improvement there. So we're taking a $5 million purchase and we are spending $5 million to renovate it, okay? As far as I know, we've now satisfied the intent here. Now, what happens is that these capital gains are deferred, and as long as this is done, this has to happen before 2019, right? 2026 is the year when there is going to need to be capital gains that is paid. In 2024, in this year, if you sell before then, you would have to pay your capital gains on this. In this year, it would be you get a 10% capital gains savings, okay? Whereas if you wait till 2026 and you're still holding the property, it's actually a 15%, okay? So let's say 2026, we have renovated a building, we are cash flowing, we're going to have to pay a capital gain at this point, which, you know, again, using my numbers, if you figure a 30% capital gain less a 15% discount, let's say $2.55 million is what you're going to have to pay then, okay? But what's happening in the meantime? We've improved a building, okay? Somewhere around 2021, you know, we're going to start getting cash flow. Let's say we build to a 6.5% NOI, so we're getting $650,000 a year, okay? This is going to continue until we sell this asset in 2029. This is year 10, okay? So why is it important that we hold for 10 years? This is when we can realize profit tax-free. At this point, we get a stepped-up basis. We paid our capital gains in 2026, okay? Now we've built a building where, let's say the NOI now is $850,000. We sell it for a 4 cap. I love 4 caps. And we've sold the building for $19 million. Let's say $18 million less transaction expenses. And so now we paid our capital gains on the $10 million. We sold for $18 million. Based on my math, we've got an $8 million profit, which is tax-free. Again, when can this ever happen, right? So as you can see, this is incredibly powerful, but before you start jumping and, you know, saying, I'm ready to buy and let's do this, and I know there's a lot of funds that have been introduced, we need to have more clarification. And the IRS is saying they will have clarification. They said by the end of the summer. Well, you know, I'm cheating a little bit. This is for September, but I'm telling you it's the end of August. We haven't heard anything yet, so maybe by the time it airs, we will. We're going to get some more clarification, like will land qualify? If I put money into the Opportunity Fund, how long can I keep it there? Because, you know, let's say that I want to do this renovation over time. Maybe I don't get to spend this $5 million in renovation. Maybe that's not required for several years. So there's a lot of question marks, but this is something that you need to pay close attention to and start doing your research, because this could have a major impact. And if you don't believe, and I'm never advocating for making decisions based on tax treatment alone, but if you don't think the tax policy has an implication on what happens in the market, how many of you remember the fourth quarter of 2012, the year before they raised capital gains, and we saw more sales in the fourth quarter than we'd ever seen before. So this is definitely something to watch. I'm still feeling like I'm just scratching the surface on this, but I wanted to give you all a sense of how this works in its most basic form. So I apologize for my chicken scratch, but I'm hoping you all can read this, and as we're finishing fine-tuning our models, we'll certainly be in touch. Thank you again.